Welcome to Conquering Your Financial Future. My name's Gavin Glozier. I'm from Your Wealth Hub. I'm the founder and director of the business. And this is our first podcast. We're super excited to be here. The main aim for Your Wealth Hub, for those who haven't been involved in our business before, is to help with as many people as we can feel confident and comfortable about making financial decisions. And out of that, we decided to start a podcast called Conquering Your Financial Future. And every 2 weeks, we're going to be inviting along somebody who's a specialist in a particular area of finance. Today, we've got Marko Savic he's a strategic financial advisor with Noall Co. And we're going to be talking about investments today and talking about the questions that most probably you're going to be wanting to hear from. So, Marko, thanks for coming on to our first podcast.
No worries, Gav. Thanks for having us.
Yeah, no worries. Look, we're going to be talking for about 8 or 10 minutes today, and we're going to be covering off some of the questions that we tend to see from different education sessions that we've seen over the past few years. We get lots of questions, and we thought we'd compile these questions and get your opinion, being an expert in this space, about things that affect everyday Australians. These questions are questions that kind of come up often, or they're questions that have been a little bit curly that we thought we'd throw at you as well. So,
sure.
Look, we want to get straight into it. So,
let's do it.
So, I suppose one of the areas that we see a lot is people talking about their ideas of investing, and that really comes down to misconceptions about the investment market. I thought maybe you could share with us some of those misconceptions and potentially, probably demystify some of those conceptions.
Well, I guess one of the big ones is, and I think this also relates to advice in general, and that's I don't have enough money to start investing.
Yep.
And I think that's a lot of people think they need a big pool of funds to start building these fancy portfolios. And I think these days with with the ETFs and Acorns and the different apps like that really help you stay on track and actually build a little portfolio with low costs. You can start with $1,000 and have a reasonable sized portfolio there.
So Acorns, they call that style of product a micro investment product. So can you just go into a little bit about what a micro investment actually is, given we're talking about small sums starting with?
Sure. So I guess these are the style of investments that it's not like a traditional fund where you have to have minimum $50,000 or something. The fees are scaled in line with the smaller sums invested, and also just means that usually they have additional ways of building it up, including rounding up transactions, and I think some bank accounts do similar things like that now as well. So it's it's a really good way for younger people, or maybe setting up for your kids to get them into investing and learning about it at a younger age. So it's a pretty good system.
So you're saying that starting small still has the impact. If you did have $50,000, you could start with $100 or $1,000. The reality is you can still invest, you can still learn the right behaviours and go from there.
Yeah, well, I think the lessons that you learn remain the same. The experience that you get remains the same. It's just that if you do make a mistake, the consequences are lower, obviously. So that's. But in terms of education and experience, I think so starting small is a fantastic beginning. So
micro investing, that sounds quite good. Do you have any kind of other misconceptions that you commonly hear that you may want to share with us?
I guess the other one is it's all too hard, and I think it's just. I guess a lot of people don't have the education around how to invest, around what to do, but I guess generally it's relatively straightforward. With a little bit of knowledge, you can set up a little portfolio for yourself. If you speak to an advisor or a professional, they can also help you along that path as well. So it's really it's just really easy to be able to do it. And I think these days. And for quite a while, we've had the online brokers, which make it quite affordable to be able to do it. So just open up a CompSec or whatever account. It doesn't cost very much, and then you're basically good to go from there. So it's going to be quite easy.
I suppose the rise of so much information at your fingertips through the internet makes it much more accessible to get the information you need to make smart decisions as well. Is that fair to say?
Yeah. I mean, I guess you have the paradox of too much information as well, where absolutely these days there's so much available online, which it means you can research anything that you want and find out detailed information, but at the same time, you have to know how to kind of wade your way through it as well without getting bogged down. So that's like almost it's almost gone too far. So
does it work the same way as like Google Doctor, where you kind of everything always ends you're going to die or something like that, or is it kind of a little bit not as dangerous as that? What's your thoughts on that?
Yeah. Well, I think the Google Doctor, WebMD and whatever. That's ultimately everyone thinks the worst, but it's it's never that bad. So. Yeah, I think it's all right.
Okay, so start small. Use the tools that are out there. Micro investing is a really good way of getting into the market with a small portfolio. It's not too hard because you do have the tools and you also got the information to help you make smart decisions. So that's really good. Okay, so in terms of misconceptions, I reckon we're pretty good in that space. So that's good. Question we get a lot is it possible to get rich quick?
Yes, it is possible to get rich quick. But it's also as easily, if not much easier, to get poor quick.
Yeah.
So I mean, absolutely, I'm an advisor and I probably shouldn't be saying this, but basically, you can get rich quick through gambling, and that's ultimately what it will be. The only way to get rich quick through the share market or through things like Bitcoin, you just have to view it as a gamble, basically. So rather than, you're not going to be building a portfolio for the long term that's going to provide, security and safety and ongoing income. If you view it just as a flutter and, just set aside that money and with full expectation that you're going to lose it, you might make a bit of money out of it, and I think Bitcoin's a very good case in point at the moment, where people have been put money in and it's gone up 1,000% in a year,
yeah.
but then it's dropped 60% or whatever within a few weeks. So it's if you're up for the ride, then sure, but definitely don't put your house on it. So.
Yeah, absolutely. So in essence, you're saying that it is possible. The risk is so much higher, so the gain could be potentially the quick win that you're talking about, but also it works both ways. You're absolutely going to lose it.
It's like putting away money on on a number on the roulette wheel, and and fingers crossed. Sure, you can make 30 times your initial investment. But there's
36
also
to the gambling man, but that's all right.
but you can also, there's also 38 chances of losing it.
Yeah.
So basically, it's it's not something you'd strive for, and it's definitely not a strategy that we recommend to our clients. But if you do like to do that kind of stuff, then absolutely, you want to factor that in and maybe set aside a little bit of money that you can afford to lose and can afford to spend, and as I say, gamble responsibly.
Yeah, okay. So that's a fair point. And, we hear people that are trying to cut corners, and I don't think it's necessarily they want to do it the wrong way. I think it's more just perhaps the education and the framework that's been around that person may not be there to alert them to the risks that are associated with a higher gain. So it kind of absolutely makes sense.
Yeah, well, I think actually one of the things in Australia that I guess compared to some other countries in the world we have that they might not have is a large market on the share market for resource stocks. That's been the classic story in Australia. You buy some 10-cent shares in a junior miner and basically hope they strike gold. And if they do, you're going to do exceptionally well. It's going to be Bitcoin-like returns. It goes from,
or .com in the late 90s.
Yeah, exactly. So it's going to be 10 cents to $5, and you're going to make an absolute killing.
Yeah.
But I mean, the fact is the majority of companies in that field, they raise the money, then they go out look for gold, and unfortunately they just don't find it, and they go from 10 cents to 0 cents.
Yeah.
So you can't, whilst you can invest them, and they certainly do have a spot in a large enough portfolio, they definitely shouldn't be the foundation of one.
Absolutely. So you're saying that probably if you are creating a portfolio, it is a very small allocation to a super risky asset, perhaps.
Yeah. It's something that, I guess, as I said before, that you're willing to lose. They're happy to lose.
That makes a lot of sense. Look, next question that we get, and this is really caught up about the new bright and shiny in the marketplace, and there's new financial instruments or products come out. These concepts or strategies take people by surprise, and all of a sudden there's a rush to move into the next best thing. What's your take on the next big thing? Should we be really wary of people being promised the world and quick returns, and not too dissimilar to the last point, but when it seems like it comes with so much confidence from the people that are presenting it?
Yeah, I think well, we've already touched on Bitcoin, and that's it's a very topical one at the moment.
Yeah, we're going to cover off the cryptocurrencies in one of our next sessions, so
Okay.
we will cover all about the world of crypto.
But basically, that is just the latest in a long line of fads, I guess. That and you've mentioned .com before, and so that's those things come around. The spruikers come out, and they push for it, and especially with things that don't have as much regulation and oversight from ASIC or APRA or these kinds of bodies, you just don't know who's saying what, and what their position is and what they stand to benefit from from you taking their advice. I'm personally a big fan of Warren Buffett, and his mantra is always, being very much, just look for, good quality, companies that, the ultimate time to sell is basically never, so if you just, if you can buy it and then just hold it because it's a good quality company, it might not be, as sexy and make, massive returns in very short periods of time, but ultimately, that's where, good quality assets will do really, really well over the long term, and most likely, save your heart a bit of trouble as well. So, yes, that's definitely something to consider.
So when we talk about sexy investments, am I right in saying that they're probably just going to be a fad, or a sexy investment's a little bit more than that, and perhaps time will actually tell how sustainable these are? Because I think of the likes of Facebook and Twitter and Google and big tech companies that weren't around 10 or 15 years ago, where at the time they're probably at the tail end of the tech boom, and they were seen as the sexy get rich quick assets or stocks or shares. But now they've actually proved themselves as being long-term sustainable business entities that have now kind of taken off some of the big players in the marketplace. How do you distinguish between the two, and what do we learn from time when we're looking at these types of businesses?
Yeah, well, I mean, they've very much become the new blue chip kind of companies. They're some of the biggest in the world, and obviously with Amazon and Google, but I think ultimately it's time is a factor. So if they hang around for a while, then you can be sure that, I guess, and they've done well over that time period, then I guess you can be sure that going forward that they should still be there. But it's just it is really difficult. That's one of the very hard things. I mean, you look at Yahoo, which also was one of the tech boom kind of companies, but that just kind of it hasn't done much. They've made some bad calls, and it's just kind of it's just done nothing. So even if you do come across one of the bigger ones that looks kind of new, then it still might not work out. So I guess that's where having a diversified portfolio. So sure, you can you can buy some Facebook shares or Apple or these kinds of companies, but I guess it's just a simple adage, like, don't put all your eggs in one basket, and that's ultimately what will shield you. If you do pick a loser out of a whole bunch of winners, then that's the losses to you can be mitigated.
Yeah, okay. So like some of those losses that we talk about may happen from time to time. Market goes up, the market goes down. When we're creating our goals that we want to be able to put into place so we can achieve our short-term, medium-term and long-term goals, based on how these companies perform, there's going to be a different risk that's basically associated to each of these companies that then fits inside where it is you want to go. Now, risk is real, risk happens all the time. As an investor, risk versus reward, how does that fit in with my long-term goals? Like, should I be holding out the whole time and just holding? Should I be changing what I'm investing in the short term if it starts going down? How does that work, and what type of advice would you give to someone in that situation?
Well, I think the first question is really how comfortable you are with with the risk and the volatility and with the market changing. I mean, if you're happy to ride it out, then and it doesn't make you too seasick, then sure, then that's definitely a viable strategy. And that'll also impact on I guess initially the investments you should have been or will be putting into your portfolio. But then the kind of the other part of that is it's important to have a good review process in place to make sure that the assets in there that you are able to differentiate in some way between good quality assets that have gone down, which represents a buying opportunity. If anything, it's the price is on sale, so now's a good time to get in, versus companies that are going down for good reasons, and due to business and structural issues, not just short-term market noise and short-term market movements.
Okay.
So that's so having a good review process there is really important as well.
So when we see at the start of this year, start of 2018, we saw some uncertainty creep into the marketplace, and that's off the back of a long run of great gains across the market as a whole. And we've heard a lot about this is the longest bull run in history, and we've had 10 years at least, well 10 years roughly of uninterrupted growth in that period. When we start seeing the market start to jitter and we start seeing these solid movement, solid swings each day, is it time to then start looking at, well, is it time to buy, or should I be taking my money out because I'm at the top of the market? How does that resonate with an investor like me? How would that work?
Yeah, I mean that's a tough question. There's a lot of factors to consider there, which we'll probably get to in later podcasts. But I think the simplest one is where you are, what stage you are in your life, what the investment portfolio and what the money is set aside for, what is planned to be used. If it's a smaller amount that that you can afford to just kind of forget about and leave it for another 20 years, 30 years, then probably you wouldn't want to be pulling all your money into cash right now anyway. If all your money is invested in the share market and that represents your entire retirement savings, and you're retiring tomorrow, then you might want to look at strategies around reducing some of the downside risk, because once you start working, you don't have the ability to recover those losses quite as easily. So there's right now is it's definitely an interesting time to look at investing, especially if you're going to put a large amount into the market that's currently not sitting in the market, because you're right, like we've had a really great run for 10 years since the last GFC, and we're not, no one knows for sure it's going to happen, but I think it's relatively safe to say that we're definitely closer to like a correction than we were previously. So so I think that's definitely something that needs to be looked at in a bit more detail.
Yeah, so that's a fair point. So understanding where you are in the cycle of your investments is really important in terms of what you do next. Okay, look, I want to wrap up with a question we're going to ask all our speakers to come in, and that's their top 5 tips. So for you, it's around investing. So I'd love to hear your top 5 tips for someone who's looking to get into the market.
Sure. I guess the first one really is have a goal in mind. So why are you looking at starting a portfolio? And that's actually going to influence a whole range of factors. What investments you make, the time frame, and that'll kind of give you the motivation to stay the course as well. So if your goal is to use the money to buy a house, the goal is to go on holiday or whatever, that'll give you the motivation to kind of see it through as it builds. So having a goal in mind and being able to state it, maybe even write it down, so then that way you're aware of it and it's there and you don't kind of forget. That's I think that's a really good starting point.
Number 1, have a goal. Fantastic. What's number 2?
So I was going to say, just start now. And
no time like the present.
Yeah, there's no time like the present. I mean, not to be flippant, but basically, ultimately with any share portfolio, unless you get the timing horrifically wrong and you do it the day before, like the massive GFC crash or something like that, then that's unfortunate. But generally speaking, it's so easy to put things off, and then next thing you know, like 6 months gone past, the year's gone past. So if you start now, even if if you don't feel 100% ready, or if you feel like you don't have as much money as you'd want to have, just as you said, you can always start small, and then that way you can just continue adding to it as it comes through. But there's no point delaying, because the longer you're in the market or in investment, even if it's not shares, even if it's just putting money into a savings plan or whatever, the benefit of the compounding from adding money in as it goes up, that generates more compounding, more interest and returns. All that is, it's a factor of time.
Great. Start now. Number 2. What's your number 3?
Be disciplined. So I think that's so if you do have a goal in mind, and that's where having step 1, having a goal in mind is really important. But when you do have that, and you make a plan. You go, right, well, to get to this, I need to do, I need to put aside $100 a month and put it into the portfolio. Then do it. That's you don't go, oh, okay, well, I'm going to put it in, and then in 2 months' time you think, oh, I really would like to go, for a quick trip to Fiji or something. Then you pull out half of it to do that, and that wasn't the plan. And so be disciplined. If you've got your goal in mind, if you've got a plan in place on what it's going to take to get there, just make sure you stick to it. I think that'll yield really good results. And
Great, discipline, I love it. What's number 4?
Don't read news headlines. Simple as that.
Bad news sells, but it's
exactly.
It's going to get caught up by it.
Yeah, one of a really great analogy that I've heard about that is you always see the headlines and it's like the stock market plunges, or the share market is soaring, and in reality it's just going up or down, and it's short-term movements that don't necessarily relate to any kind of big picture. As you said, because that kind of stuff sells, whether it's bad news or if it's just if it's big news, it sells. And the analogy is if you got into an elevator and the only two options were skyrocket and plunge, instead of up and down, I don't know how comfortable I'll be getting pressing any button in that elevator. And that's ultimately what it is.
That's a really good analogy. I love that elevator analogy, and I always wonder, why isn't the news jumping all over the next day $30 billion gain in the stock market? Because
those dollar values mean nothing. It's like 50 billion wiped off. It's like it's just
in the scheme of things,
it means nothing. Yeah.
Okay. So don't read the headlines. And the last one, number 5, to close out.
If you're feeling uncertain, or if you just want more information, don't hesitate to speak to a professional who knows about it, and they can actually help guide you through the process from start to finish. So it's not just about picking which shares or which stocks or which managed funds. I mean that's part of it, but it's actually a relatively small part when you look at your bigger picture, and that's really what's key.
For your goals, it's being big.
Yeah, well, so you're starting off with your goals and then the time frame. As I mentioned previously, how comfortable we are with with investment risk, because it could be a great investment, but if you don't like a share price moving down 10%, in the space of a couple of months, even though it might be a good thing in the long run, then that's still not going to be the right investment for you, because if you don't sleep well at night because of it, well then it's not going to be beneficial. Yeah, so absolutely, speak to a professional, and they'll be more than happy to help out, and I think that'll also be they add value ultimately over the long term, and I think that's good for you.
Great. Have a goal. Start now. Be disciplined. Don't read the headlines. Speak to a professional. Marko, thanks so much for coming on today.
No worries.
Our first podcast, Conquering Your Financial Future. We've had a great time. We've covered a lot of topics. I've got a lot out of that. I hope you have too. We're going to be talking every 2 weeks on Conquering Your Financial Future. Please jump onto Facebook, like us, share it with your friends. We'd love to hear what you think about our podcast. And until next time, my name's Gavin Glosier. I'm from Your Wealth Hub, and we'll see you really soon. Thanks a lot.
Thanks.